Nice to have you with us, Steve. Everybody else, Leslie, Milford, Ragda, let me know. Just give me a yes in the chat box. Don't want you to be muted for the whole webinar, so just let me know you're all there. Nice to have you here, Sajan. Nice to see you here, Duran, Leslie, Johan. Nice to have you with us too. This time I double checked and I'm now recording this webinar, so you can go over it. We'll put it up on the website for you. I'm sorry about the last one. Due to the difficulties with the application, it didn't record it. So I'm going to go over what we did last week, because this strategy, it's a proven strategy, and I've used it for many years. I keep telling people, what I did in the past and how many years I've been a trader, a professional trader now, for about 23 years. Started when I was 21, and I'm still doing it. 42. I have a great life, working with CM Trading now. Hopefully, building the company up to great things, and looking forward to seeing the company really grow. We are one of the few companies that we really do care about you guys as clients, and we want you to be successful. And when you make money, we pay the money to you. The profits are yours if you make them. A lot of other companies out there, you make the money, and they don't want to give you it. So okay, so I'll make a start, and we're going to go over, as I said, just a few slides I've added to the PowerPoint, which I'm going to run through the whole PowerPoint, and then we're going to go to some charts. I'm going to just show you a euro dollar chart. This strategy can be used on any instrument, and it just depends on the type of trader that you are. Are you a scalper? Are you a long-term trader? Are you intraday? You can use this strategy no matter what kind of trader you are. So this is one of the reasons I wanted to show you. And we'll move on to the next slide. Just want to go over the disclaimer. I want you to use a strategy, and I want you to be careful traders, manage your trades. Don't put your account too much at risk, because we've all done it before, and a few of us are doing it recently, and we're letting the markets control us instead of controlling the markets. So this technique is a great way of what we call trade management. Also money management strategies, they're all inside of this. It's one of the strategies that I've read up on, I've used for many years, still use it now, amongst 10 other strategies which I use. It depends on what the market's doing. We've all seen what Mr. Draghi and Mrs. Yellen, when they speak, the markets, they obey their words. When they say that the euro is going through difficulties, or we're going to raise the interest rates, then we see these currencies or CFDs or commodities going crazy. Today was a day that was full of news from the euro, full of news from the United States, and we saw an increase, in a matter of minutes on the euro, 20, 30, 40, 50 pips. During non-farm, it's over 100 pips. This strategy will help you to hopefully predict and control your trading. I'm going to show you in future presentations how to do basic hedging, which you can build into this strategy. This is just the beginning of a new strategy for you all, something that you're going to try. try inside of a demo, please. Don't on your live account. Get used to using it, and you know, you'll find that it will benefit you. The goals of the webinar, you know, most of us don't do it. We don't check the charts. We don't zoom out. We don't look at weekly charts, and we don't look at the long term. You know, what the trend is. You know, how do you define what the trend is? You know, you must look left. You know, my saying to all new traders is always look at the market, always look left, because price will always obey previous areas of support and resistance. You know, using the price action. Many of you guys, you know, when I do a team viewer with you, you know, you're covering up the price with 1,000 indicators and moving averages, and you know, you can't see what's going on in the market. You can't see the price. You know, it's very important to be able to view it. Switching from using Japanese candlesticks, you know, we all use Japanese candlesticks. They are very, very nice ways of viewing the price action. We can see the open, we can see the high, low, and close of each candle. It can give us an indication of where the market's going to head. Identifying support and resistance. People still, you know, a lot of you are still struggling with, you know, is this a resistance? Is it not a resistance? You know, how do we recognize a support or resistance? The more times that the market touches this price, the more significant that area is. The higher time frame that you have on your chart, the more significant that support or resistance is. There's no point in taking a 1 minute chart, 5 minute chart, putting on your support and resistance lines on there, because they don't hold, you know, significant, you know, significant areas of support and resistance. They're not, you know, big. They're not, you know, significant. You know, you need to move out to a daily, a 4 hour, you know, a 1 hour chart, put all of your support resistance on there and create something which we call channels, which is identifying a tradable range. Look at that range, try to trade it to the top, to the bottom. I've been looking at oil. You know, we all know what's happening with Iran at the moment. Oil was trading an unbelievable range, top to bottom, bottom to top. And, you know, all commodities, you know, suffered because of the strong dollar. I traded gold myself. You know, I'm a big gold trader, a big pound dollar trader. And, you know, there were some fantastic ranges in there. Heiken Ashi. Heiken Ashi is just, it's a way of taking the average of a candle, you know, and painting it in a specific color. It basically, Heiken Ashi means average bar in Japanese. Average bar means taking the open, high, low, and close and dividing it by 4 or dividing it by 2 to give us the open and close. The high and low, it's a mixture of the high, open, and closed, and it's the highest value in the set, as you can see here. If you take a look at the formula, basically, it doesn't really matter what the formula is. The candles are either whatever color you have them, red or green, black or white. It's very, very simple to use, which is why I wanted to show you guys. If we take a look at a Heiken Ashi candle, you know, they do the same things as Japanese candles. They, you know, they paint themselves, in this example, red or green. And what we've got to look at is, you know, is it a continuation? Is it a weakening of the trend? Which means if we have open trades already, we're looking to exit those trades. Is it a continuation? If it's a continuation, we may want to scale in. We may want to add volume into our trading. I'm going to show you a few examples of scaling in and scaling out in the presentation. Review this recording again. Pause the recording when you're looking at it, and look at these candles. You can see that when there's tails high and low, that, you know, you can see that the trend is weakening because the price doesn't know in which direction it's going. Look at the second example, pattern 2, signifies a continuation where you have a tail on one side, a wick, and a wick on the other side. Price is testing high, not being able to achieve higher price, and coming back again, painting the candle red, and again we have a wick at the bottom, significant, which means that the overall trend is weakening. Pattern 3, this shows it's a sideways or consolidation of pricing. We've all seen it when the market, drops 100 pips during non-farm. It puts the market into shock. After shock, then the market needs a certain amount of time to recover, and we see it going sideways. And this is okay, because if the market's going sideways, it means that we can identify a range, even if it be only 20 pips. For you guys that want to open and close lots of trades, range trading is the best way in which you're going to make money. For people that want to stay in the trades for a few days, you need to be looking to identify the trend. Determining the master trend. A lot of you, it's very confusing. Is it going up? Is it going down? You don't know. You play. What happens to most people, especially new traders, is it's almost as if somebody's on the other side. Every time you open a trade to buy, then the market falls. You lose money. Then you think, well, I'm going to sell it. Then when you sell it, the market goes up. It's as if somebody's operating a remote control against us and is making us lose. But that is just the way that the market is. There will always be retracement, and using an indicator called Fibonacci, it will indicate the amount and the size of the retracement and where to enter trade. So it's very confusing for some people determining the trend. Now, the way in which I determine the trend, or what I call the master trend, which is the overall trend, is to go to a higher time frame of chart. Look at this example is a daily chart, a daily Heiken Ashi. Which way is the trend going? We can see very easily that the candles, there's much more green than there is red. So we know that the market's moving higher. Is it making a higher high and a lower low? So we can see that there's progression. So we can see the amount of pullback. We can see that, the market, I'll highlight it for you. The market it works in phases. First phase, pullback. Second phase, pullback. This can be also known as Elliott wave, where we have 5-wave consolidation, and then what we call an ABC pattern. There will always be this pullback. There will always be this pullback. The market needs to correct. It needs to, in order to move higher, there has to be a certain amount of retracement. Fibonacci is a fantastic tool, because I'm sure that if you put a Fibonacci, let's say from here to here, and your Fibonacci goes from low to high, that this retracement here will be either 38 or 50%, which is it's an indication that the market's going to move higher again. So this is how you identify the trend. Go to a higher time frame of chart, and you'll see it straight away. It stands out a mile at you. Trend determines the direction of our trades. I see a lot of people, trading against the trend. The trend is our friend. It really is. If you try to trade against the trend, then you're going to suffer. There will be retracement, and you can make money, but always better to work in the direction that the market's moving. Leslie, I'll do a few examples after the PowerPoint. I'll show you on the euro-dollar chart, on the live chart, and we'll draw some Fibonacci's on there for you, no problem. So once you've determined the master trend on the daily, then I want you to move the chart to a lower time frame, 4 hour, 1 hour, maybe 30 minutes, and then you can pick your trades. So it's whatever you're comfortable trading with. Some people like to trade on a 4 hour, some people like to trade on 15 and 30 minutes. Scalpers, people who like to trade intraday. The most popular time frame is 1 hour. So it's wherever you're comfortable with. Only place trades on color changes. So if the trend is up, then you're wanting to place a trade when the candle turns green or whatever color your Heiken Ashi is. On my MetaTrader, I just stuck with the default, which is red and white, and I'll show you on the live chart. This is an indication on a 4-hour chart. As you can see, this time the market's moving down, but we have a trend change at the bottom. We can see that we have the one phase down, correction, second phase down, slight correction, then we have a big drop. If we count the number of times, this is going to be 1, this is going to be 2, we can count this whole thing as 3, maybe count this as 4 and then 5, and then we may go sideways. That's Elliott wave. So we have 5 waves. When we put a Fibonacci, if we want to measure, for instance, this amount of retracement, we would place the Fibonacci from high to low on this, and for me it looks as though it's around 50% retracement of this move here. So we could place a short trade if we wanted, but we need to wait for a color change on our Heiken Ashi. So just let me get rid of that. So we'd be looking for the first red candle. We'd be looking to enter a trade here on this candle, and then the exit of the trade, we're looking for a change in color again. We're looking for the first or the second green candle. So we place our trade here and we exit on this candle. If you want to stay in the trade, you can, but whatever you do, don't get caught out by a pullback. This is the worst thing. It's awful when you're making profit, the market starts to turn against you. You think, oh, I'm going to stay in it for a few more minutes, and then the market goes boom, and we lose all our nice profits. My tip here is don't be greedy. If you see the trades making money, either bring your stop loss down. If you're entering on this red candle, when the market moves to here, why not just bring the stop down above this candle here? If the market moves back against you, we make this tiny amount of profit. Better than a loss. More profits than losses will equal total net profits inside of your account. So the 4-hour chart, moving back to Heiken Ashi, determining direction. We're going to look for this color change here. I just wanted to put the arrow on. Color change and entry. If you want to play safe, enter on the second green candle on the 4-hour. I'm also going to show you on the next slide how to put a moving average on there. On the picture, it's a 20 period EMA, which is an exponential moving average. I like to use 21 day. I don't know, whatever suits you. It can be 19, it can be 23, it can be 22. It's whatever fits the chart. You have to look at what the market's doing. You're not the one that dictates where the market will move. That's for sure. If you think you are, then you're going to lose money. So I always tell traders, and I have a very good friend in South Africa called Robert, and I drilled it into him. We need to see 3 things before we entering a trade. Triple confirmation. 3 things. First thing is slope of the EMA. Is the slope coming down? Let me draw on the chart. Is the slope coming down? Yes. So we know that as long as the price stays underneath the moving average, that we have a trend that's moving down. When we see the market start to move close to the moving average, then we know that there's a possible reversal of trend. And the Heiken Ashi is going to help you here. In combination with this 21 period day moving average, you're going to see that it works magic. It really does. This is a 1-hour chart, and the blue line is a 20 period moving average. So basically we're looking for changing color, second candle. Maybe looking for an entry on this candle here. Where do we exit As I said on a previous slide, we're looking for the first red candle coming back against us. Probably going to take the profit, or be smart and maybe move our stop loss, maybe 10 or 15 pips behind that candle there, so that we're not triggered on a spike or something from this candle. Maybe the spike's going to come down like this and take out our stop. Doesn't matter. We made money. We made the money from here to here, even if it's only 20 pips. We made 20 pips. Nothing to stop us from re-entering, either on the first green candle or the second green candle. Keep opening and closing your trades. Take the profit. Don't be greedy. Don't stay in the trade for too long. Question from a level guy. Do we wait for the close of the second color change to enter? It depends on whether you want to be a little bit plate safe. My advice is, when you're looking for entries using Heiken Ashi, is entries on entry points should be done on 15 and 30 minutes, and then you should monitor your trades on a 1 hour, because if you're looking on a 15-minute all of the time, the market's always going to be, the Heiken Ashi will change color very quickly. I'm sure that if we looked on a 15-minute, that these 3 candles here, there's 3 hours, so there'll be 3 hours worth of 15-minute candles, and I'm sure at some point that there would be a color change which would take you out of your trade too early. So monitoring the trade on a 60-minute, as long as the market stays above the 21 period moving day average, then you can stay in your trade. If you're in a trade from here, if you're entering on first red candle or second red candle, we're underneath the moving average, market's moving down, we don't even have to get out of the trade on the first green candle. We can wait for the market to move back to the moving average, maybe make an exit here. We're going to lose a few pips, we're going to lose these pips here, but who cares? We made our money from here to here. So you have to try to be intelligent traders and not be greedy traders. Take the profits of your winning trades. Don't stay in there too long. Moving on to the next one, trade size. I am the chief dealer at TM Trading. I see all of the volume coming in and out of the company. I see some of the trades which are hideously oversized. People trading 10 lots of euro dollar on a $1,000 account, 5 lots of DAX on a $5,000 account. This is what we call too much volume, too much risk, very, very dangerous trading. So a few tips for you here. If you're thinking of entering a trade on the euro dollar, if you love the euro dollar, then, and your usual trade size is, let's say, 2 mini lots, then why not go with 1/5 of the size of the trade? So we can split the 2 mini lots into 5. We can go for 4 micro lots. First trade 4 micros, so 0.04, and build your trade size up. This is called scaling in. So if the market, you're testing the market, you're dipping your toe into the water, into the market, and you're testing to see if the market's going to move in your direction. If it doesn't, then you're only 1/5 of the size that you normally are. So what are you doing? You're controlling the losses. This is called trade management. I don't see a lot of this happening. People just like to fire the biggest amount of volume into the account. Some people only have $500 account. I work with clients and my own personal clients in the UK. I'm working with upwards of account sizes of $1 million, $1 million, trading for these people. And it's different for me. I can open up 10 lots, 20 lots of pound, and in relation to the balance on the account, I'm only using a very small amount of margin, a very small trade. If you have $1,000 account and you're using a mini lot, then you're using 1/10 of the account, which is a lot. So you have to think about the size of the account. Scaling out, you know, it's exactly the same thing. Scaling out is removing volume as the market moves in your direction, otherwise known as a partial closure. You know, if you have 5 mini lots open on the euro dollar and you're $1,000 in profit, then why not close out half of that, 2.5 or 3 mini lots, and leave the other 2 mini lots in the market to run? Then, you know, you're taking profit, and you know, you're making money. If it comes back against you on the other 2 mini lots, then, you know, hopefully you've moved your stop losses as well, so they're going to hit the stop losses. 3 steps to entry on every trade. Step 1, you know, what is the master trend? Remember, you know, you're looking on the daily first, and then you're moving down to a 4-hour or 1 hour. Step 2 is looking at the trend, you know, the slope. 21 period exponential moving average. Last Heiken Ashi bar and price relation to the EMA must match the chart, you know, the primary direction. Step 3, you know, I'm going to show you on a chart stochastic as I did before. This is a great way of adding another confirmation to an entry. And I've done a small calculation. If you use the strategy correct, always stick to the rules, you know, you'll be 75 to 80% accurate on your trades. Now, 75 to 80% accurate means nothing if you're using too much volume. You know, if you're making 75% profitable trades, but your losing trades are much bigger, you know, if you're making 10 trades and 7.5 of them are profits, and they have $100, and the other 25 you have a $300 loss, then your risk and reward is in the wrong direction. So you need to do something about size of trade, how long you're stopping in there for, use of stop loss. You know, I personally, I don't have stop loss on any of my trades, only a positive stop loss. I don't use negative stop losses. If my trades go significantly negative, then I'm into what we call protective hedging, which is something I'm going to show you in a later webinar. So the conclusions, you know, the pros of the Heiken Ashi, you know, much easier for you to read the chart. You can detect the trend and the shift in trend very easily. It's very user friendly, good for beginners. You know, it eliminates all of the spikes, all of the market noise you have on a Japanese candle. Very good in a trending market. And when in combination with other indicators such as the stochastic, which I'll show you, you know, it's a great tool for making money. The cons are, you know, the indicators, they're lagging, you know, and they don't show the true price action. The Heiken Ashi, as I said, they're an average. That you don't see the gaps in the Heiken Ashi. The Heiken Ashi will fill with a color if there's a gap. So, you know, what you should do is you should have a combination of, if you love to trade the euro dollar or the pound, have 4 charts, 2 Heiken Ashi, 2 Japanese, and have them on your screen so you can see the gaps. You can see the true price. As I said, you know, at the very beginning, price action is very important when we're trading. Okay, any questions so far? Okay, I'm just switching to the platform. If there's no questions, I'll move into a chart with you. What I have here, you know, I'll explain what's going on. I'm going to put a 21-day moving average on there for you. I'm going to start off with a very wide, very long time frame. This is a weekly, so just let me put a moving average on here for you. One second, trend, moving average, 21, right, okay. Let's make it a different color. Let's have it a nice loud blue. exponential, as you can see, 21. Okay, great. Okay, 21 period doesn't really mean anything on a weekly, because I want you to monitor the trades on an hour, half an hour, that sort of time frame. Once you have the trade open, it's not really much use monitoring a weekly. But I've drawn some trend lines on here for you because they are relevant, even on the smaller time frames. Indicators which I have on are stochastic at the top with 14, 7, and 3 settings. These are my own settings. A lot of people may use the same, may use a 14, 7, 5. And at the bottom, we have ATR, which is average true range. I like the ATR because it gives me the average true range of this indicator. In a week, if I put my cursor on there, we can see that the average true range is around 339 pips on the euro. This allows me to determine, where to put stops, how much the market's going to move in a week, because I don't want to put my stop too close to the market. So I think it's pretty obvious which way the trend is moving on the euro with all of the Greece fiasco which is going on. This chart goes all the way back to 2013. I want to show you, using Heiken Ashi, I'll get rid of the Japanese just by switching to a bar. As you can see here, pretty conclusive. If you look at the Heiken Ashi, which way the trend is moving, it's very obvious. We've got a downtrend going on here. Is this a reversal or not? Well, nobody really knows. We have a little bit of pullback. If you look at a Fibonacci, it's probably going to be around 23% retracement on a Fibonacci. I'll put it on just for Leslie. We're taking it from the high side to the lowest low, and yeah, roughly 23. I can sort of tell where the percentages are. We're doing it for such a long time now. The market, in theory, it could pull back to 38, which would mean a continuation. The market may come up, fail, and move down lower. The market's going to test previous pricing, as I said to you before. So, we need to have horizontals on here. We need to have areas of support and resistance. You must have your support and resistance on your charts. If I switch to a monthly, just zoom out a little bit more, I want to see where the market's been. Look at that in 2001. I'll put some horizontals on here for you. I just want to show you how significant price is and how important it is to have a long-term horizontal. Create your channels. Where's the market going? Where might it go? You can see here already, the market tested this price back here in 1997. This currency, was barely born in 1997. But we can see, there was a test, a push higher, and a fail, and a push down low when it was around 80. I remember when it was around 82, 83, back there in 2000. So what I'm doing here, just showing you the significance of identifying price ranges that are over 15 years old, and the market will, I guarantee you, will obey where these prices were. We can see here great support here. Put another one here. I want to keep it, I don't want to do too much on the chart. I don't want to hide everything, but I want to I'm looking at this price area here. I want to see where the market's been within that price area. Theoretically, if the market breaks this price where it's at now, there's nothing to stop it visiting this price. Nothing at all to stop it. Here there was a little bit of support, resistance, back here the same. We have tested the price here, we tested the price here, we tested the price here. Theoretically, nothing to stop it from moving here at all. But it's going to take time. It's not going to be something that's going to happen in a week. You know, we need to put the channels on here and move down in terms of time frame. So we'll switch to a daily. You can see here that the purple lines, they're still relevant. You know, they're very, very relevant. I'm going to get rid of that Fibonacci because it's a long-term fib. You can see here that we know that the purple areas are weekly support resistance. And what we need to do, we need to split the weekly ranges down into daily ranges, maybe change the color of your horizontal, you know. So identifying the daily supports, you know, this was a nice support here. I'll just draw on here, you know, this was resistance, nice support, fantastic support, resistance, resistance here too, resistance here. You know, where price tries to go higher and fails, this is where we're looking. This is opportunity, this is money, this is where we're entering our trades. So let's zoom in a little. Let's get rid of my pen. We'll zoom in on a daily. These trend lines, you know, I put them on for you on a weekly. I put them all on here. Move back to a daily. You know, very, very relevant. You know, we can see market is, you know, it's obeying and it's searching for that price again, linking up the tips of the candles, not necessarily the shadow or the wick. You know, we're linking price. I like to go by the body of the candle. You know, some people like to use the wick. You know, I like to have some touching of price action, and we can see that the market, you know, tested and failed. It tested and failed. You know, body of the candle, move higher. You know, what are the rules of entry? You know, now we have another couple of things. The stochastic, this is going to confirm our entries. You know, we're looking for something around 20. You know, around the 20 area for an entry long. We're looking for the blue line coming up through the red for a long entry. The blue line coming up through the red for a long entry. You know, the blue line coming up through the long for a long entry. You know, then we're looking at our charts. You know, I'll just put my cursor on. So rules of entry. You know, we're looking for first or second white candle, and you can see here that this price action is very, very volatile. You know, in a day, we can see back then, in a day on this candle, volatility rose from roughly 131 pips to nearly 200 pips just in this move. The ATR is very good for telling us how much the market's moved. Very important, you know, for when we're going to get out of our trade. How are we going to handle our stop loss? You know, so let's do a theoretical trade. You know, where is a good entry? You know, this was fantastic. This was a great entry. Don't get confused by, you know, the first red candle. Don't exit the trade, you know, all of the time. You know, you're putting an entry on what I spoke about. Maybe you should wait for the second color change. You know, don't go with the first. It's a little bit risky. But, you know, this worked out. You know, if we didn't have our stop too close, then, you know, it would have been a great trade. So we're not placing trades on the daily. This is just an example of the color change. We're going to look now for an entry. Okay, so we're going to move to a 15 or 30 minute. Let's take a look at the market in terms of a 15-minute chart. Heiken Ashi entry. Okay, lots of them here. You know, look at that. I mean, it's pretty definable which way that trend is moving. Much more red on the chart, and you know, the trend is definitely moving down. Even on the 15-minute, we know it is, because the daily it's moving down. And we can see here that we have consolidation. Markets going sideways, you know, it's moved up a little, it's going sideways. Get your horizontal support and resistances on and you'll make money top to bottom, and it's part of your three-step strategy to entry. So back to the 15-minute. So we're looking for the entry, we're looking for a good entry point. Okay, let's zoom in. I can see one, it's screaming out to me. You know, remember what I said, blue line up through red, blue line up through red here, anywhere around this point. I'm looking for a white candle. You know, the market's crossed here. Sorry about that, the application just not letting me draw. Market's moved up, stochastic up through red trigger line, entry here. Don't put your stop loss too close. If you're going to use a stop loss, don't put it too close to the market, or you're going to lose. You're going to get spiked out by the market, and the trade's going to close. Market's going to go boom, and there you are with the theory that somebody's standing with a remote control and it's controlling the market against you. Wait, be patient. You know, look at what the market's doing. I'll just shrink the screen down a bit. Good entry point. So we made, let's say we made our entry here on this candle. Looking at the ATR, you know, how many pips is it moving in the market at this point? It's only moving 12 pips. So, you know, you want to take those 12 pips and maybe add and maybe double it, or maybe put 10 pips on. So 20, 22 pip stop loss. What was the opening price of this candle? Opened at 108.711. Let's see. Let's move that down. Let's say we entered at one. Let's say we entered here, and I'm being generous. It's above the open, so we entered here, and we're looking at, you know, where do I put my stop loss? I don't want to lose my money. I really want to use a stop loss. Every professional trader I talk to tells me I must use a stop loss. Okay, we're going to use a stop loss. What did we say about the 21 period average? You know, markets move down. It's interacting with the market here. Something's gonna happen. You know, I have a good feeling it's gonna move higher, it's gonna move up. So 22 pip stop loss, is that big enough? Well, look at that. It's around 23 to here. So you have to be generous with your stops. Let's say we put 30 pips on. Okay, 30 pip stop. 108.47. 108.47. Okay, that's our stop. Gives the market room to breathe. You know, we're waiting for the market to move up higher through the moving average. If it goes up through it, chances are it's going to keep going, but on this occasion it didn't. You know, we're looking for a short, quick entry. We have 30 pips. What are the rules of risk and reward? Oh, actually, we have 20. Oh, we have 30. Let's say we have 30. Will the market give us back 2 to 1? That's the golden ratio. It's the minimum that I'm willing to take on a trade. I'm not willing to risk 30 pips to get 30 pips. I need to get 60 or close to 60. So can I achieve 30 pips from our entry? So our entry was somewhere around here. Okay, we entered here. Do we get 60 pips out of it? We get around 54. You know, 54 pips. Don't forget, you know, the charts are the raw price. They don't include the spread. So when you're setting your take profits, you know, a lot of traders making mistakes, and you know, not looking for that tip right at the very tip. 109.26. If I have my stop loss here, it's not going to trigger. I need to include half of the spread out, half in, half out, half a round trip, a full trip. So we need to be with stop loss 2 pips. Let's say the spread's 4. I need to be 2 pips below here, so 24. Need to be here, 24, 23, 24 to get an exit. Okay, quick question. Would taking that trade not be going against the trend? Well, yeah, it is absolutely correct. But if we're looking to scalp, then we have a confirmation from the stochastic. We have the first white candle. It can be this one. If we entered here, it's not an incorrect place to enter because we're looking at our stochastic. But we said previously, Lebegang, that the indicators are lagging. There's a bit of a delay. So why not wait until we get the second white candle here, make an entry on this? And you're absolutely correct. We're counter trend trading, and as I mentioned before, it's a little bit risky, but you have to have all of these things confirming to you that there's going to be pullback. Let's say that we're going to strictly stick to our trend trading rules. We identify the downtrend, so we're only going to place short trades. Okay, it's going to work exactly the same. We're looking for, instead of the blue line coming up through the trigger line, we're looking for the blue line coming down through the trigger line, as close to the 80 as possible, such as this area here. So we're trying to look at this area here in combination with the change of color. So we can see that the market moved up, and because the trend is down, as my friend Lebegang said, we're going to wait for either the first or the second red candle. Okay, let's say we enter here, okay, and we're waiting for a color change to exit. What's confirming to me that the price is going to continue to go down is the fact that the stochastic, the lines never touch. There's always what we call separation. There's always a gap between the lines. This is a confirmation that the trend is intact, that the trade is intact, I'm sorry. So we can stay in the trade and ignore the white candles. We're using indicators to confirm to us that our trade is safe, it's open and it's running. If you want to play safe, then you can go strictly by the rules. As I said, there's there's thousands of books. I read hundreds of books, Goldman Sachs, JP Morgan, professional traders writing books on how to trade, and that is the way that they trade. I traded stocks for 10 years, and I trade a little bit of currency. I don't trade lots, but I do it just to back up. I trade different areas of the markets. I trade stocks, I trade commodities, I trade forex, to make a little bit of extra money. But most of my money is in stocks. I'm a stock trader. But the currency, it behaves very, very similar. Actually, it's actually a lot nicer to trade currency because there's more liquidity, there's more volume in the forex market. So when I want to buy or sell the euro, there's always a price available. With my stock trading, if I have 1,000 stocks of Microsoft and it costs me £20,000 to buy the stocks, then if I want to sell and sell and make a sell position on Microsoft, I need to offer my stocks onto the market, and I will only get that price when somebody offers it me, when somebody wants to buy them from me. Forex, you don't have that. You think about Forex as a seesaw. When somebody is buying the trade, then there's always a balance. There's somebody that's selling the trade. So there's always some kind of balance. So as we said, back onto the chart, we're waiting for the first color change. Either here we're going to enter, or here we're going to enter, and we're going to wait for the first white candle. So we'll measure the amount of pips. Now it's going to be very small because we're using the 15-minute. You can look at the same charts on a 30-minute, and again you'll see a beautiful example of the market being controlled by the moving average. I really like, there's no set fast rules here. If 15-minute looks tatty, and it's not a good chart, move out to another time frame. Does that fit my moving average? Well, I think I prefer to trade on this chart. I don't know about you guys, but you know, there's some great entries here. The stochastic's a little bit messy. It's not moving up to 80, but we know the trend is down. We don't need the stochastic, you know, to tell us which way the market's going. Let's say, you know, that we want to, you know, we're looking for the blue line coming through the red, but it's nowhere near the 80. But if you look at the trend, you know, this was a great entry. You know, this point here, candle change color, we enter our trade, it's below the moving average, it's moving down. What do we do to look for an exit? First white candle and we're out. That's one trade. Master trend again. Market moves down, one red candle, we enter, we get out. We didn't make many pips there. Change of color again. Nice big red candle there. We enter the trade. Market moves down really nice here. This was a really nice move. We exit. Now, if we take our sweet time and we don't exit the trade quick enough, then, you know, you may lose, or you may make a smaller amount of pips between there to there. If you get out too late, you need to be looking for the stochastic to cross back up. This is telling me to exit. You know, the stochastic's moving up through the red even before we have a white candle. So we know something's going to happen. The ATR is rising. So we know that the number of pips are increasing. We call this acceleration, market acceleration. When there's an acceleration in price, a signal from our stochastic or MACD, even you can use MACD on this, it works just as well, but I like the stochastic. We can see now, you know, live market conditions, euro dollar 30 minutes. We have a nice change of color, you know, place our entry. Markets move down already to here. We're already in the trade. The markets, the lines come down. It says something's going to happen here, Andy. I'm looking for, you know, another red candle, or we may already be in a trade. We may have already entered a trade. Forget the stochastic. Look at this. First red candle after the white. We could enter. We could be in the trade till this candle. We're out. We're back in again. Or we're back in again on this candle. Will the market move down overnight? Well, nobody really knows. Nobody has a crystal ball. Nobody knows the answer. You know, I think, you know, we're going to test previous price. As I talked to, always look left. Where will the market go? Nobody knows, but I guarantee you that it will test a previous price. Look at that, 108.47. We know that this is significant. It's a daily or a weekly horizontal. It's a support or a resistance. I don't know because I'm using a 30-minute chart, but I know that it means something. So we have a place to set a target. We can set our target, our take profit here. Always important, you know, even though I don't use stop losses myself, always important to have a take profit. You know, what do I want from my trade? I want 2 to 1, 3 to 1, 4 to 1, 5 to 1. So I'm entering here in this area of a chart on the red candle. What if I'm using a stop loss? You know, I don't want to be too close to the market. ATR is high. Let's see what the ATR is. If my entry point, it's roughly a second. ATR is 23 pips. So I want to be at least 10 pips on top of this, maybe double, so 40 pips. If I'm entering the trade here, 30, 40 pips. If I put 30 pips in, I'm safe. I'm giving the market room to breathe. 109.32. You know, will I get 60 pips from my trade? Well, if I'm entering here, I'm looking for 60. Will our purple line give me 60 pips? Well, it gives me around 54. I'm happy with 54 pips. If the market moves down 54 pips, you know, I'm going to make, if I'm on a mini lot, I'm going to make $54. But I'm only risking 30. So I'm going to make almost double my trade. This is trade management, you know. So going back to the PowerPoint, you know, 3 things to get us going on a trade: color change, trend direction, confirmation of an indicator. Is the market below the moving average if we're in a downtrend? If we're in an uptrend, is the market above the moving average, as pointed out by my good friend Le Bogan? You know, we need to have all of these things in place before we place a trade. Biggest tip of the night: you don't have to always be in a trade. We're looking for good entry points. They come along very often with Heiken Ashi. If you look at the Japanese candlestick overlay, the white candles are the negative and the hollow green candles are the positive. You can see that they fill the gaps. You know, we can see that there's 20 pips of wick on a Heiken Ashi, but it's the body of the candle on the Japanese. So you can use this in combination with Japanese candlesticks. I just love the Heiken Ashi. I like the way that it just stands out to me which way the market's moving. I'll take some questions. Anybody got any questions? Anybody want any indicators adding? Something you're not sure about? Maybe I can put a Fibonacci on there and we'll test the retracement. Let's do a Fibonacci for Leslie. Previous Fibonacci. Let's go from high to low. Where did the market pull back to? You know, I want to focus on price. You know, 50%, 60% retracement normally means a continuation. You know, if it breaks 61.8 and continues to move up, then chances are we're in a reversal. You know, the market's going to move higher. We can see here it obeyed the Fibonacci rule. It didn't go. It tested above the 61.8 but failed, and we can see the market move nicely down. So we can measure this retracement. If we want to counter trend trade, then there's a good chance that the market, you know, why not enter on the white candle, you know, and trade it to 50 or 61. Better to trade it to 50 though. So, you know, we're entering here and we're making 25 pips just from using Fibonacci. If we enter on the cross of the stochastic, you know, we know on the Fibonacci there's a good chance it's going to head to 50. If we were clever and we entered here, or on the very first change of the white candle, we would be making to 50, we'll be making 30 pips. But my advice to you is the EMA, the moving average, identifying the trend on a daily, then going to a 4-hour, then going and monitoring your trade on a 1-hour. So we placed our entry here on the 15. Now look at it on a 1-hour. Look at that 21 period moving average. It's just beautiful. It's controlling the market. You know, the market's not daring going above there. If we use a Heiken Ashi strategy, you know, and we were looking for entries there's not as many on this chart, but they're more significant. Can you see how much more significant they are? If we're entering on the color change of red, you know, wow. I mean, if we entered here at the top, you know, first color change, do we have a confirmation from the stochastic below? Is the blue line moving down through the red? Yes, it is. You know, do we want to use a stop loss? Well, your stop losses are going to be bigger, and your take profits are going to be bigger. So if we measure the ATR on this particular trade, then our stop loss, you know, our ATR is saying roughly, it looks to me like 15 pips on here. So if we want to double it, let's say 25, 30 pips, we enter on this candle, 25 pip stop. Okay, very, very safe. way above the market. As the market's moving down, what are we waiting for, guys? We're waiting for first white candle, exit. Look at that. This move alone from here to here, gonna get you 67. What did we say our stop loss was? 30 pips. This is why I want you guys to monitor your trades on 1 hour. If you're looking on a 15-minute, you're going to get hacksawed. You know, you're going to ripsawed, sorry. You're going to have spikes. It's much more messy. The 1 hour is beautiful and clean. It will allow you to monitor your trades much better. Okay, questions. Let's take a look. Please show one example on the 1 hour chart with stop loss and take profit from Steve. Okay, let's put some stop losses and take profits at the very top. Okay, we can put it on down here, but I think the best trade of the day was at the top. Even here on this particular candle, you know, Steve, a very nice way of setting stop loss in combination with your ATR is to use the moving average. You know, on the 1 hour, you know, if we're entering on a 15-minute, you know, or even you can enter on the 1 hour. Better to look on the 30 or the 15-minute. You know, we're looking for the first color change, which is here. This is at 10:30 on the 16th. Okay, go to the ATR. 13 pips, so double it, 26. So we're going to make our stop loss here from here to the top, 26. Okay, 26 pips, 109.55. 109.55. Okay, that's our stop loss. Okay, what I want you to bear in mind is the market's moving down. Don't leave that stop loss there. Bring that stop loss down. It's called positive stop lock. You know, you're using 3 bars to bring the stop loss closer to your market. Lock in that profit. Okay, we're entering. I'm going to put the entry. The entry is here. Stop loss, 25 pips. Can we get 50 pips out of this trade? As long as it stays below that moving average, we're golden. So we're moving down. 75 pips the market moves. And even more influential is the fact that we have a support resistance line here. This is a target. This is where I'm going to put my take profit. I don't know the market's going to go. I don't know the market's going to go to here. Hasn't happened yet. You know, I can scream out to you, do this, do that, because I know the market's gone here. I can see it. If the market's not painted itself yet, if you know, I don't know what's going to happen here. It may go up, may break, who knows? But just for example, you know, set your take profit on support resistance. Very important to have these lines on here. I want to see price. I want to see what's going on, you know. So stop loss, 25 pips. Take profit, 60 pips. Sounds good to me. 2.5 as a risk and reward. You know, these are the golden rules of trading. Another entry point, you know, with a big spike. You know, look at the ATR. Look how much the ATR moved. You know, switch back, just measure it. ATR's at 21 pips. You know, even higher on this entry. It's at 21, so we need to put 40 pips. Stop loss, at least, on this. 40 pips is high, you know. Look at where that is. I do not want to set a stop loss that high, but what I can do is I know there's a support resistance line at 109.31 in purple. Set it on that. You know, you're 28 pips. This is a resistance, even 30. Put it at 30, but we need to get 60. So we're looking for 60. You know, the market's only given us 30 pips. We're still in this trade, unless we use a Heiken Ashi rule, which means we didn't get greedy. We're not in the trade anymore now. White candle, we're out. But what tells me this move is going to keep going overnight is the fact that we have separation here. Market's going to keep moving. I think, you know, we're going to test this one of these 3 prices here. Don't know which, but we know we have a really strong area of support. So we may see a shooting up in price, even back to the top here, to this resistance support. I hope that helps you guys out. I'll just take one more question from Fakamisa. If I'm not in a trade now and I'm expecting a reversal on the Euro USD, where could the reversal be? It's a very, very good question. If what do you mean? If you're looking for an entry again, so if you're not in a trade, I'm expecting a reversal on the Euro. Okay, if we're expecting a reversal, how much may the market retrace? Good tool for measuring that Fibonacci. Take it from high to low. Let me put you a quick Fibonacci on here. So we're going to take it from the peak, right from the very top of the candle. Do we want to take it to the lowest low? Well, why not? We're looking for the market, maybe I would probably take it to here. Looking for 50%, as high as 61. Market, if it retraces to 50%, going to give us this area here for retracement and entry. So the market may move to 50% and then move back down again. I think more likely, looking at what's going on with the stochastic, is that there's going to be continuation and move lower. Probably test this area here. So I'm going to leave it there for tonight, guys. If you want to attend any more future webinars, I'll do a part 3 on this. We'll take it to the next level. We'll place some trades on my test account. So in the next webinar, we can see if the trades are successful or not. It's been really great having you with us. I hope it's not too confusing. Review the recording. Look at, very important, as I said, identifying trend, conclusion of the webinar, trend identification and monitoring of your trade. Oh, and by the way, sorry, I forgot to mention that when you're in a trade, this particular trade here, you need to use 3 bars. Bring your stop loss down, please, please. Don't leave the stop loss up here. When the market moves 3 bars down, you want to bring your stop down. I would bring my stop if I had an open trade there. When the market moves 3 bars down, bring it either above the moving average. As the moving average moves down, this is going to be our stop. So we will probably get stopped out in this area here when the market spiked. Or, if you use 3 bars, you will still get spiked out. So you need to bring it down. So 3 bars to here. Another 3 bars. Did the market move lower? Yes, it did. Move my stop to here on this candle. Market moved down again, 3 bars. Bring my stop down to here. Market moved down, but then spiked back up. So this would be an exit on this trade. It would have been closing us out here. How many pips did we make? We entered on the red candle. Let's measure, just for the last thing to do in the webinar. I just love the markets. It just fascinates me that there's so many patterns, and it's what we call a self-fulfilling prophecy. So many people staring at the same chart using Fibonacci that the numbers are relevant. It's not magical. It's just a lot of people, a lot of eyes looking at the same chart. We would have actually made roughly 35 pips. So yeah, if you can do that 4 or 5 times a day, you make 100 pips a day. That is a significant amount of money, even on mini lots. So I'll leave it there for tonight anyway. I will definitely be back for part 3 of this. We'll move it to the next level. One of my colleagues, James, is going to be doing some hedging. I showed him my hedging strategy. He's going to show you some additional. And my colleague Fred will be with you showing you trade management in the next week. Have a wonderful evening. Pleasure to be with you all. Sleep well, and I'll have the recording up on the website for you guys. Take it easy. And any questions you have, just send it to my email, martino@cmtrading.com, and I will be happy to answer you. Have a wonderful, wonderful evening. Good night to you all. Bye-bye for now.